Good morning and welcome to our webinar, Preparing for COVID-19 Recovery, Loan Options and Forgiveness Strategy. And today is March 4th, 2021. Beautiful day, and it's getting warmer. Yes, this is powered by Saks LLP, Saks Wealth Advisors, also known as SaksWA, and our technology arm, S2 Solutions. And this is the slide in which we tell you that you do need to understand that this webinar is for general guidance only, and it does not constitute the provision of legal advice, tax advice, accounting services, investment advice, or professional consulting of any kind. Therefore, you should be consulting your professional advisor, and we are here to help you to answer any questions that you have and work through all the different details. Welcome today. These are our presenters, myself, my partner Josh, Steve, and the lovely Debbie Nappy, who is joining us to talk about HHS and all the things you want to know about that. This is our recovery task force. You perhaps have spoken to some of them. They are working hard behind the scenes to get those applications in, and forgiveness, Angelo, Melissa, Amanda, Julia, and Matt, and there's been a few other people added. We're going to update this slide, I think, in the future. So what are we going to talk about today? Well, we're starting right now with the introduction. We will be speaking about some interesting PPP loan stats, some common issues and questions, PPP loan application and loan forgiveness, some common issues and questions concerning the employee retention credit and the HHS provider relief fund and PPP considerations. So, start off with our very first polling question, and this will also help us to explain what you need to do in order to get CPE today. So how do you receive one CPE credit for this webinar? Again, assuming that we go the full 50 minutes. Answer 3 out of 4 polling questions, stay for the whole webinar, or complete the evaluation form in the handout section, or all of the above. And so that's the very first polling question, and also we'll give you some clues if you do want, and really want the CPE today, what you need to do. So we're opening up the polls, and you need to answer the questions. We have about 56% voting so far. Keep it open a little bit longer for those of you who are looking for CPE. By the way, if you're looking for the evaluation form and you look on your screen, you'll see a section that says handouts. That's that little tab there that says evaluation, participant evaluation sheet. You need to complete that. I'll give you a few more seconds so everyone has a chance to answer. And I'm going to count down 5, 4, 3, 2, 1, closing out the poll. Let's see the results. The folks who said all of the above, that was the right answer. If you want CPE, you have to do all three of those items. All right, so I'm going to start off by talking about some really exciting PPP loan statistics. First exciting loan statistics, and this has been updated through February 28th, 2021, has to do with who is getting the loans, what industry sectors are getting the loans, and the top winner is accommodation and food services, second is construction, and third is professional, scientific, and technical services. You can see the numbers there, who's getting these loans right now by industry. So let's move kind of take a look at the loan size. Predominantly, and it shouldn't be a surprise, most of the loans are $50,000 and under, with only a very small number, 61, that are over $5 million. So the smaller loans are the ones that are being applied for and being granted, and the overall average loan size is calculated to be $71,000. Next exciting stat is who are the top lenders in providing for the 2021 PPP loans. And JP Morgan Chase Bank is leading the way, with Bank of America following a close second. So let's talk about some common issues, PPP loan applications, and PPP loan forgiveness. First, let's start off with some recent updates. There's been some recent changes from the Biden-Harris administration. There's been an exclusive window, and I'm sure you know this, to apply for funding from February 24th, 2021 through March 10th, 2021 for borrowers with 20 employees or less. And $1 billion has been set aside for businesses in low and moderate income areas that do not have employees. Also, directed the SBA to issue clear guidance confirming that otherwise eligible law U.S. resident applicants may use ITINSs to apply for PPP funding. The interim final rule also came out with revisions to the loan amount calculation and eligibility, which applies to both the first draw and the second draw PPP loans. It enhanced borrowing opportunities for certain borrowers with prior non-fraud felony convictions, and also those who had delinquent student loans. The modified loan amount calculation for individuals who file Schedule C with their federal income tax return, this was also updated recently in the same interim rule. Prior guidance limited Schedule C filers to payroll costs if employees existed plus net income. And this prevented many independent contractors, sole proprietors, and other self-employed individuals from actually accessing the PPP funds. And so gross income-based loan amount is now calculated, which will reduce barriers for these borrowers to acquire the funding. It's effective for PPP loans approved after the effective date of this IFR. So borrowers with PPP loans that have already been approved, unfortunately, cannot increase their loan amounts using this methodology. This is a case where waiting maybe would have improved your chances, but who knows what they're going to do, the SBA. They're such clever folks. There's also some new loan application forms that were released yesterday. Those of you who like to collect forms, there's two new ones. The Form 2483 first draw and the Form 2483 SD, standing for second draw. So there's some new loan application forms. And you just need to know that since they're allowing you to base this now on your gross income, they also came out with in this interim final rule, or this interim rule, saying that loan amounts that are greater than $150,000 calculated under this methodology will not automatically be deemed to have made the loan necessity good faith certification, and therefore could be subject to the SBA review and safe harbor for borrowers who, along with affiliates, received PPP loans less than $2 million also will not apply. Of course, the $100,000 compensation cap still applies, but so if you are applying for that loan for greater than $150,000, you will not be able to fall under that good faith certification item. Question that's come up is, can lenders deny the extension of the loan term from 2 years to 5 years So if you remember, if you were prior to the change in the law, June 5th, 2020, you were under 2 years, and then after the June 5th change, you were eligible or actually required to have the 5-year term, but it grandfathered you in, saying that if you might be able to negotiate with the bank to get a 5-year term. And so we just want to clarify that that still is a negotiation. You need to go to your bank and request it if you had the loan granted to you prior to that June 5th, 2020 date. So you're looking to extend that date, you need to talk to your bank and negotiate. Also, there's been some loan application issues, some error codes and denials, loan amounts per employee. The SBA limit loan amounts to $35,000 per employee, and applicant documentation. So there's been some issues. There's you might have read up that there's some math errors that have caused loans to be bounced back. There's been some wrong spelling of the companies or the wrong tax ID numbers. You know, one number can throw the whole thing off and cause all kinds of problems. So what we'd like to tell you is that obviously when you're applying for the loans, make sure you actually check all the math and that all the information is correct, because it will screw everything up if you don't do that. Will there be a third draw PPP or PPP 3.0? I don't know the answer to that. I don't think anyone really does yet. We will see if we will have round 3, which brings us to the next CPE polling question. Now, obviously, you can answer this question even if you don't want CPE, but if you do want CPE, you need to answer 3 out of the 4 polling questions. So, first, what is the name of Sachs's new podcast? Is it Take 5 with Sachs, 60 Seconds with Sachs, Sachs Power Hour, or The Best of the Rest? So which of these is the name of the new podcast that Sachs is now put out in the marketplace? Take 5 with Sachs, 65 Seconds with Sachs, the Sachs Power Hour, or The Best of the Rest? And we are going to let you actually do the poll right now. Keep on answering the questions. We are up to about 67, 68%. So I'm gonna let you go a little bit longer to answer that question. Take 5 with Sachs, 65 Seconds with Sachs, Sachs Power Hour, The Best of the Rest. And I'm going to be counting down to close out the poll. 5, 4, 3, 2, 1. Poll is closed. And if you answered Take 5 with Sachs, that was the correct title of the new podcast. Sachs Power Hour, I guess, got the next most. It's only 5 minutes, so I don't know if we would have called it the Sachs Power Hour. Okay, and at this point, I'm going to turn over the presentation to Josh, who's going to continue to tell us about common issues and questions regarding loan forgiveness. Josh, take it away.
Hey, thanks, Todd. I like Sachs Power Hour. Maybe we should rename this Sachs Power Hour, the best 60 minutes every week. But just wanted to take some time here to address some common issues and questions surrounding PPP loan forgiveness. Again, a lot of these questions are issues that we encounter while preparing applications, questions which continues to come in through the COVID-19 website, and just general questions from clients. So thank you for continuing to provide feedback and questions, as it gives great information for the webinars which we do. So first one, payroll costs. Should we include total payroll costs or only payroll costs to the extent needed to achieve full forgiveness? I think we've seen so far that best practice is to include total payroll costs. This way, if you do happen to have a salary reduction or an FTE reduction, it gets reduced against that gross amount. So if your payroll cost exceeds the loan amount, that provides you with a bit of a cushion. The next one is with regard to PPP loan forgiveness and the employee retention credit interaction. So should we include total payroll costs or total payroll costs less amounts used to claim the employee retention credit benefits? So if you actually look at the PPP payroll reports that the payroll providers are doing, you'll actually see that there's a box there for the employee retention credit. Now, obviously, none of them have been filled out because everybody's been going forward with the PPP, and the ERC has kind of become a very hot topic only very recently. So, but really, to answer that question, and it kind of goes hand in hand with the second question, is that with respect to the ordering rules, is you're actually supposed to, if you claim the employee retention credit, the first 10,000 of wages is supposed to go towards the ERC. So if you haven't submitted your application yet, and you do plan to claim the ERC, I believe you should reduce your total payroll costs for those wages allocated to ERC, but make sure that it's more correctly on the PPP payroll reports, which you provide as support for the overall spend on your loan. And then the third question, can we retroactively claim the employee retention credit if we have already filed for and or have received PPP loan forgiveness? The answer is yes. There is a notice 2021-20, which provides specific guidance in the area, but the answer is yes. We have a lot of folks who have already submitted and received forgiveness, and now we're going back and applying for the employee retention credits. And then the last one on this slide here, payroll cost reports. So one of the things that I'm seeing a lot, again, on the payroll reports coming from the payroll companies, is that the owner's compensation is being calculated at the full amount. So the high end, for 24 weeks of $46,000. We know that owner's compensation is limited to the $20,833. So please make sure when you submit your application, even if the payroll report is wrong, you make that adjustment. Also, too, the one thing I think you need to consider, again, not something that the payroll company would have any insight to, is if you have folks who are not direct owners, but owners, through beneficiaries of trusts, and their ownership is above the 5% number, you probably should be limiting those folks as well. Again, is that something that's, knowledge that's readily available? No, but I think what we'll find is the more upfront and correct you are with how you report, the better. Okay. Full-time equivalence. Does transferring employees between related entities give rise to an FTE reduction? The answer is yes. But I will couch it by saying this. I think it's important to look at your covered period multiple ways, right? A lot of people are defaulting from 8 weeks to 24 weeks. Well, what if that employee was still, on the entity for which you received the loan for 16 weeks? Maybe it makes sense to go forward with the shorter covered period in order to not experience that reduction, because remember, you do have the ability to calculate the forgiveness multiple ways using different covered periods as such. So if we use the Form 3508EZ or the Form 3508S, do we need to provide support to the lender for the fact that we are claiming that there was no FTE reduction? So depending on the lender and what their requirements are, I think the answer here tends to be yes. They want the support for their files, in the event that the SBA has any questions for them. So don't be surprised if you submit an application without it, that it's something that you are later asked for. Not for profits. So how do not-for-profit entities that receive funding from other sources report the eligible wages on the forgiveness application? And should not-for-profit entities include all the payroll less that amounts funded from the other sources? So this is really a tough question, and I think the answer really is it depends. One thing, I think about, and Todd and I have had this discussion many times, is that, when you prepared the application for the loan, you use your organization-wide payroll. So if we're going to go through the process of having to carve employees out that were grant funded or reduce what their eligible compensation was because they were funded by other sources, you're not only going to have to do that for the forgiveness application, but you're also going to have to go back and sort of recalculate from, basically the original loan. I think it's important to have a spreadsheet of all of your employees and how they're funded and what's being allocated to each program. And then I think it's a conversation with the bank as to how they'd like you to go forward. I don't know that that there's a one size fits all here, as you're not only dealing with the bank, the SBA, but you're also dealing with the funding source. So I think it's important. I believe the bankers are being educated with respect to this. So I think it's really a case-by-case basis. Next one, lender SBA considerations. Will the lenders and/or the SBA use hindsight when considering forgiveness applications? This is a tough one. I really think for the first loan, again, this is just my opinion, I would say they would not use hindsight when considering forgiveness, but it's hard to say that they won't for round two, as there's a lot more information available today. So I don't know. I think it's going to be on a case-by-case basis. It could very well be dependent on loan size, and it could, there's other factors that could come into play there as well. Will we run into issues if we make our annual profit distributions to company owners after we apply for forgiveness? I think that goes back to the first question. The answer may be yes, the answer may be no. A lot of this depends on the SBA's thought process as more applications come in. They seem more, also too, negative press in the news does not put the SBA in a good spot. So again, depending upon where issues arise, they could change their approach. We also do know that a lot of lenders have kind of temporarily closed their forgiveness portal because there's potential, they're waiting to see if anything happens in Washington. So there's a lot of things to consider with respect to all of this. And I think it's really important, again, specific case by case, that you not only make a decision internally, but you consult your advisor. Next question. In instances where the borrower does not apply for forgiveness, can the proceeds be used in any manner without repercussion? So as part of the loan application process, borrowers are required to certify that the funds will be used to retain workers and maintain payroll, yada, yada, yada. Can the federal government can hold borrowers legally liable? Again, this is not really a working capital loan. It was never the intent of what the program was. So the SBA can really decide to go in any direction that they want with this. Last question. After loan forgiveness is received, can the SBA still audit the borrower? So yes, the borrower is required to maintain all documentations in its files for 6 years after the loan is forgiven or repaid in full. So you talk about a real long runway there. So the answer is yes. Also, the borrower must permit the SBA, including representatives of its Office of Inspector General, to access such documentation upon request. So really, just because we're out of the woods with forgiveness, if the bank pushes it through and the SBA pushes it through, just know that the SBA always has the right for this extended time period to come back and take a good hard look. So will they? who knows? Again, another kind of question that only time will tell the answer to. Okay, please provide examples of non-payroll costs for covered supplier costs. So right out of the definition, so if you actually look at the forgiveness application, there are definitions with respect to the new categories. So with these, it's essential to the operations of the borrower at the time the expenditure is made, and it's made pursuant to a contract, order, or purchase order. So, and again, it further defines that as those that were in effect at any time before the covered period, or with respect to perishable goods like food, in effect before or at any time during the covered period. So kind of a catch-all. Again, I think those second two bullet points are really what's key. And then please provide examples of non-payroll costs for covered operations expenditures. And I think here's the most important piece right here: payments for any business software or cloud computing service that facilitates business operations, product or service delivery, the processing, payment, or tracking of payroll expenses, human resources, sales and billing functions, accounting. Know a lot of clients out there have upgraded their accounting software. This would be something that would be covered there. And then tracking of supplies, inventory, records, and expenses. So a lot of the folks, a lot of the positions who may have been moved to a remote, operating capacity here during the pandemic, really the costs associated with that, again, assuming they fit into any of these buckets, are now included as eligible expenses with respect to non-payroll costs. And just lastly, just to throw it out there to everybody, we do have a tool available at the firm here to prepare the forgiveness applications, and it will basically provide you with the package which you can turn around and submit to the lender if they'll accept that. If not, it provides you with all the information to enter directly into the bank's portal. So it's, like I said, it's been very successful to us, and if anybody's having issues or challenges preparing their reports, feel free to give us a shout. Okay, now I'm going to kick it back to Todd for poll question number 3.
Poll question number 3. Okay, so let's ask the next question related to the Take 5 with Sachs, who are the co-host of Sachs's new podcast. Myself, Josh, or is it Josh and Steve? Is it myself and Craig Cassano, or is it Steve Ehrenberg and Joe Damiano? So that's your choices. Start voting to see whether or not you know who the co-hosts are of the new Take 5 with Sachs podcast. I'll give you some time. It's interesting. I'm watching how people are voting to see if this is also going to determine whether or not you've actually listened to the podcast. The podcasts are coming out. You can find them on our website. They're also being sent out as e-blasts. So you can go onto our website and listen to any of the past podcasts. We've had at least 2 so far. Give you a few more seconds, because this is the 3rd polling question. I want to make sure that people actually answer the polling question so that they can get the CPE. All right, and counting down. 5, 4, 3, 2, 1. Who are the co-hosts of the Sachs's newest podcast, Take 5 with Sachs? And it looks like it was a tie between Todd and Josh and Todd and Craig. And the right answer is it's Todd and Craig Cassano are the co-hosts of the new podcast. And you should be looking for that so that you can be listening in. Although I will say that the next podcast will star Josh Shenani. He's going to be interviewed. Going to hand this over now to my partner and friend, Steve. Common issues and questions regarding the employee retention credit. Steve, take it away.
All right, thank you, Todd. I always find these webinars particularly compelling. I'm admittedly biased, but learning about all these new facts, it's been very interesting and getting a lot of information out of this. So thank you. So I'm going to take over the employee retention credit aspect of this. We saw a new notice, as Josh mentioned previously, that was just put out earlier in the week, Notice 2021-20, which basically codified, if you will, a number of the FAQs, but also provided some interesting information about interaction with the PPP. There's a list of examples, even for those borrowers who are going to retroactively go back and claim the employee retention credit, that basically the SBA is not going to penalize you if you included all your payroll costs on line one, but some of those payroll costs were actually used for, ultimately will be used for the employee retention credit. They're basically going to only look at the minimum. So this is a very borrower / taxpayer friendly item that's in there and something you'll want to pay attention to. The notice itself is over 100 pages, but if you look at the examples on pages 74 through 80, they really lay out some good scenarios, and hopefully you've included all your payroll and non-payroll costs in your form, and you can kind of get the best of both worlds. But if you have any questions, certainly feel free to reach out. So one of the items that's been of particular interest, and we tried to list the common issues and questions, is how is the employee headcount determined? Irrespective of how many employees you have now or in 2020, it's based upon your 2019 average full-time equivalent. So the 100 employee or FTE threshold, or 500 in the case of the 2021 credit, is based upon, again, 2019. And for FTE purposes, that's employees that worked at least 30 hours a week or 130 hours in a month. And the single employer aggregation rules apply here. So you have to look at entities that essentially are under common control, be it in a parent subsidiary or brother sister calculation. And just so you know, it can get rather confusing, and there's a lot of different rules to kind of muddy the waters here. So just keep those in mind. So what's included in qualified wages? Well, these are specifically defined in Internal Revenue Code under Section 3121 and Section 3231. The definition, when you're comparing this versus payroll costs from the PPP, it's a little more restrictive, but they're still basically your wages and cash compensation and certain stock options. But also you can include qualified health plan expenses that the employer pays, provided they're not included in the employee's gross income, because that would be included in their wages to begin with. And also, just so you know, wages paid to certain related individuals are not going to be included there. So paying a whole bunch of your family members may eliminate you from room in the retention credit. Okay, so as I was saying, if you're talking 2020 and the rules are different between 2020 and 2021, the head count, the FTE count matters. So if you have 100 or fewer FTEs for the 2020 credit, essentially all your wages that were defined on the previous slide are going to qualify up to $10,000 a year. But if you have more than 100 FTEs, it's only wages paid to employees not to work. And severance is excluded, and essentially you can't just pay somebody a huge amount right before a certain period. There's a 30-day timeline that's going to be taken into account, and this is just for 2020. This threshold, when you're over the 100 FTE limit, was removed for 2021, so it's not as restrictive. In 2020, the qualifying eligibility is a governmental shutdown or significant decline in gross receipts, not and. This is a question that's been fairly common. So you don't have to have both, it's one or the other. And a governmental shutdown can be fairly broadly defined. It can be partial or fully, and it can depend upon an essential or non-essential business. So take a look at that. But the significant decline in gross receipts is a little bit more mechanical. For 2020, it's a greater than 50% decline in a 2019 quarter versus a 2020 quarter. And then this decline basically it continues to be in place until gross receipts reach 80% of the 2019 amount. So basically, if you have one quarter that qualifies, so if you had a decline in, say, in Q2 of greater than 50%, until those gross receipts get back to 80%, the following quarter will qualify. So what this means is that if Q2 qualifies, Q3 at the very least is going to qualify as well. And when you have a quarter that qualifies in a significant decline in gross receipts, all the wages paid will apply, subject to the limitations we discussed earlier. Whereas if you have a governmental shutdown, it's only the period when the actual business was shut down for when those wages apply. So again, something to consider when you're going through the credit calculation. So 2021 expanded the opportunities, bringing the 100 threshold to 500. So now if you have 500 or fewer FTEs, it's all qualifying wages. Again, it's up to 10,000 a quarter versus the 2020 credit is 10,000 a year. And I'm sorry, and that should say more than 500 FTEs, it's qualifying wages for employees paid not to work up to 10,000 per quarter. And you have your governmental shutdown or significant decline in gross receipts. But whereas the 2020 amount was 50%, the 2021 is only a 20% decline. And this is comparing 2019 to 2021. However, the 2021 credit allows you to basically look at the prior quarter. So if you had a greater than 20% decline in Q4 2019 versus Q4 2020, then 2021 will count as well. I get it, these rules are rather confusing and it seems like we're somewhat repeating ourselves, but this is kind of how it works. So I do think if you are going to look to qualify and it's not fairly obvious, reach out to an advisor. Josh had mentioned earlier, no double dipping. So you cannot claim the PPP benefit and the employee retention benefit, on the same wages, but you can claim it on the same employee. So we listed an example here where employee A earns $15,000 in a quarter. The first $10,000 will go to the employee retention credit, the next $5,000 to the PPP. So something to keep in mind as you're going through your credit calculation. What's the maximum per employee? Well, it's different per year. So 2020, you take the 10,000 wages earned in a year, and it's and multiply that by 50%. So the maximum credit you can get per employee in 2020 is $5,000. Whereas in 2021, it's 70% of the 10,000 per quarter. So that's 7,000. So if you add that up, you get 7,000 times 2 is 14,000 plus 5,000. So you could get a maximum of $19,000 per employee. So again, a pretty significant benefit, but keep in mind that the rules of Internal Revenue Code Section 280C apply. So the wages, so these wages that you're applying the credit against, they will be added back into taxable income. And state treatment may differ. So for instance, New Jersey makes you add back the wages, but actually New York does not. So just again, when you're going through it and multi-state opportunities arise here, you're going to want to take a look at that as well, because the add back may not occur, although it occurs at the federal level. So essentially you're paying tax on the credit, but you're still getting $1, but paying $1 of tax. So you're still in a net better position. But not every state follows the rules of IRC 280C. So here's a question that comes up fairly frequently is, will the employee retention credit be extended? Currently, it only lasts through June 30th of 2021, but those of you who have been following what's been going on Capitol Hill will see that the recently passed by the House, but not the Senate, the American Rescue Plan talks of extending that credit through the remainder of 2021. So definitely something to consider, to follow. They are hoping to pass that by the middle of this month. It's right now back to the Senate because that's when the unemployment benefits expire. So we hope to see within the next 10 days to 2 weeks as to whether or not this becomes law, and keep a close eye out for our e-blasts, and you'll see we'll put some information out about this. So next we're going to talk, a lot of questions come up, well, what are the documentation requirements and who's watching? Well, just because when you're submitting for this, be it on an amended 941X, on a current 941, or if you're going for the advance on 7200. Just because you don't have to supply that information when you're applying, it doesn't mean that you don't have to supply the information now. There's a lot of information that needs to be at least kept in your files in terms of were you subject to a partial or full governmental shutdown, was more than a nominal portion of your business shut down, because not a nominal portion allows you to qualify, which the notice that we mentioned earlier defines nominal as if your gross receipts is not less than 10% or hours of service is not less than 10%. So you're going to want to keep in mind all these, or keep in your files at least all these different records, decline in gross receipts, how you determine healthcare expenses and whatnot. So, and again, the aggregated group requirements, the single employer rules, how those apply as well. On the next slide, we also show that you need to keep any 7200s. That's if you're going to get the advance credit, and the federal employment tax returns as well. And like we said, who's checking? Well, the IRS is checking, and you need to keep these records for at least 4 years after the tax becomes due or paid, whichever is later, and the IRS can come in and look at that at any time. So with that, I'm now going to turn it over to Debbie to talk about the provider relief funds, and I see that there's a number of questions in the chat box. If we get a chance after Debbie's done, we'll try to look back at those. Debbie?
Thank you, Steve. Good morning. My name's Debbie Nappy, and I'm the co-leader of the healthcare group here at Saks. So you might be wondering, why are we going to speak about the provider relief funds today following the PPP recovery as well as the employee retention credit? But as it's been stated already, for any healthcare entity that has received these dollars, there is now an interplay between PPP, the employee retention credit, and now the provider relief funds to make certain that when we're reporting on all of these dollars, we cannot double dip. So now we have 3 programs that we need to be cognizant of in regards to making sure that you as the client or provider, you are now going to receive the benefit of all of these programs. So I'm going to try to go through as quickly as I can, in that when we originally reported on this, it was an hour-long webinar. So in general, the Provider Relief Fund was established with the CARES Act back in March 27th of 2020, and it was provided to support healthcare providers. Funds were put into the CARES Act and then therefore distributed out to hospitals, physicians, skilled nursing facilities, and it came out in 3 different phases, as well as targeted distributions, with the last phase that ended for your application process on November 6th of 2020. With the signing of the Federal Appropriations Act at the end of 2020, additional $3 billion was authorized to put into this fund. Now, I just want to make it known, just like you can apply for PPP loan forgiveness, these distributions are not required to be repaid back to the HHS. They want you to retain these dollars, but we have various criteria that has to be met in order for the dollars to be retained by your healthcare facility. In addition, so here are the requirements. When you first receive these dollars, you are required to attest that you are going to use the funds in a certain manner. You're not allowed to bill for out-of-network co-pays, and you had a whole list of what you could and could not do with these funds. So that was step 1 when the money was deposited into your bank account. Now we're going to the reporting phase as to what's required. If your entity received less than $10,000, you have no reporting requirement. Their money is a grant, it's a gift, it's taxable if you're a taxable entity, not taxable for a tax-exempt entity, but there's nothing more you need to do. However, if you received in excess of the $10,000, you have to first register on their registration portal, and we thought report all of these expenses as of February 15th, but the HHS came back out and said, we're not ready due to the signing of the Appropriations Act. This reporting deadline has been postponed to an unannounced date. However, if you did not expend all of the dollars, which I will go through, or you cannot make it up in lost revenue, we're going to give you these first 6 months of 2021 to still meet this requirement. I'm just providing this to let you know, this is the division, the Health Resource and Services Administration, that first dispersed the funds, and now they're going to be the ones who are responsible for the reporting portal. So I've provided, or we have provided in your handouts, you have a handout as to how to go on to the reporting portal and at least set up your registration process. So that's a first step that you need to take care of. And on the next slide, this is just all of the information when you sit down to register. This is what's going to be required, because it times out. You cannot save the information and go back in. So they state that it should take about 20 minutes due to one pass. And then once you're registered, you're going to get a confirmation email that you're in the system, and then they're going to follow up with updates to let you know when this reporting portal will then open. So it's a two-prong test, and you have to report on both. It's either A, you've spent the dollars that they provided to you for health-related care costs for COVID-19, or you're gonna replace your lost revenue, which will go through the calculation for the funds that were received. When on January 15th of 2021, they came out with a new calculation for lost revenue that I will go through shortly, as well as there's still a little bit of confusion, and we're not sure yet that when you do report on these dollars, are you going to be reporting on the cash basis, if your cash basis for your tax return, or is it going to be accrual basis for your financial statements? So there's a lot of matters in this that still have not been clarified, and we're still waiting for further clarifications in the FAQs. So I just want to lay a foundation as to what expenses would be included. What's the framework? So what they say in the FAQs is this expense necessary and reasonable to support patient care efforts to prepare, prevent, or respond to the coronavirus? And is this expense that you incurred consistent with your organization's policies and procedures? They also go on to say that it's for the treatment of confirmed or suspected cases. So it's basically your patient care when a patient comes in. And in addition, just one notation, the dollars that you received cannot be utilized to pay back any accelerated and advanced payment that you received under the CMS program. So now we're going to talk about the two-prong test. So first you have healthcare related expenses attributable to the coronavirus that have not been reimbursed by other sources. So this is where we get back to the PPP loan. If you received a county grant under the CARES Act for rent expense. So you really have to look and see all of the various grants that you've received during this year, and they have to be netted against these expenses before you can then report on the expenses for the provider relief funds. In addition, you have to maintain these records for 3 years. So once again, the only thing to really pay attention to on this slide, and you're going to have our slide deck, it's really hard to go through all of this, but I just wanted to provide you with what are the other sources. What other sources of funding did you receive in 2020 that you have to now net against these expenses in order to prepare this calculation? So this middle paragraph provides you with all those varying programs. So now I'm going to go through quickly the expenses that need to be reported within a range. So if you received $10,000 or more, but less than $500,000, these are the expense categories that you need to report on, as well as you're still going to have to then report on your lost revenue. So what they say is you have G&A, your general and administrative expenses, as well as your healthcare related expenses, which I'm going to go through some examples of what those would be as well. Now, if you received in excess of $500,000, you have an additional level of subcategory reporting of G&A expenses. Now, if you look at these, they look very similar to what you're reporting on for your PPP loan. You have your mortgage. Here, insurance isn't health-related insurance. It's actually malpractice. Personnel. Now, this is where you really need to plan with your advisor. You could have hired additional security personnel. Maybe you've given bonuses, some sort of hazard pay for your employees to come back to work during this time. If you've already utilized those dollars for the PPP, you now cannot utilize those dollars for the PRF, as well as you have to be careful if you want to qualify, or if you do qualify, for the employee retention credit. So that's why now more than ever, you really have to do these programs together so that there's planning opportunity with your advisor as to where are you going to utilize these dollars to make sure that you are getting the best benefit for all the programs that you are a part of. Now, I just want to spend a few minutes here. So for supplies, or expenses related to healthcare, right? We have PPE, all of our dental practices, right? The shields, the gloves, hand sanitizer, everything that you are purchasing and you've ramped up as a result of COVID. Equipment, right? Back to a dental practice, a medical practice, any equipment that you've had to purchase to prevent, prepare, respond to the virus, right? Here, if you're a hospital system, you have ventilators. You might have updates to your air filtration system, HVAC. All of this was as a result of COVID. Now, we were just speaking about IT, right? Under the PPP, you have your non-payroll costs. You really want to be careful once again, because if you're utilizing those for the PPP, you're not going to be able to utilize them for the PRF, and maybe you really need those additional IT costs for this PRF reporting, right? So many practices have switched to telehealth. You have legal fees that you've incurred as a result of that. You have additional cloud expenses, software. I've even had practices whereby they've purchased extras laptops so that the physicians can work remotely. Cable bills in regard to paying for the home cable expense in order to be working remotely. So you need to really consider all of your expenses when looking at these funds. Facilities, if you had a temporary facility structure, you had to lease another structure. And one other thing I want to mention that just came out in the FAQs at the end of January is now you have vaccine administration and distribution. So if you purchase refrigerators, freezers, any personnel costs, transportation, anything not reimbursed is now also another expense that you could utilize for this program. Here, I'm just reiterating, go back, look and see if you've made any capital equipment purchases. There's varying FAQs as to can you expense them for PRF initially? Do you have to depreciate them? Please reach out to us. We are going to provide you with an email address at the end. Any questions? This is very detailed and complicated. Please send them over to us and I will be certain we will respond to it. Once again, the facility, right? Did you retrofit anything? Do you have any upgrades to your HVAC? Dental practices had to do a lot because patients were so concerned to come back to their practice, right? There was fear and you had to do things to make certain that your patients are safe as well as feel comfortable coming back to your facility. Now, for those of you who received, in addition to the $500,000, you are going to have other non-financial metrics and information that they are going to require, and it's going to be required actually quarterly as far as personnel metrics, patient metrics, facility metrics. So just be aware that in addition to the expenses, lost revenue, you're going to have to provide other information as well. And in addition, if anyone has received in excess of $750,000, you are also required to have a single audit. There is relief in that you can ask for an extension for when it's due, but just know that this will be required. And now I'm going to go into the calculation of lost revenues. So basically, either way, like I said, you have to report on both. You have to report on your expenses, as well as you have to prepare this lost revenue calculation. This calculation, the HHS has changed it numerous times, but this is where it stands right now. You have to compare your 2020 patient revenue compared to 2019 and look to see what were those dollars that you lost during that period, if any. Not every practice has lost patient revenue. Some are healthcare facilities, some actually then picked back up at the end of 2020 in quarter 3 and 4. One thing that they just introduced with the January 15, 2021 FAQs was you can now look at the budget that you had in place for 2020, as long as it was approved and in place prior to March 27th, which is the signing of the act. And then you'll see there in a later slide that that budget has to be certified by the CEO, CFO, that in fact it was in place. And the last method that they allow you to currently utilize is a reasonable method. So you can then determine a reasonable method of calculating your revenue. However, beware that most likely this reasonable method might be audited, and then if they determine that they're not in agreement with it, they could go back and then hold you accountable to either one or two. Once again, I'm not going to go through this again, but here is just option 1, 2, or 3 as to how to calculate your lost revenue. For purposes of time, I'm just going to move to the next slide. And then here's now the options. As I said in the beginning, if you did not meet the requirements of retaining these dollars through the end of December 31st, 2020, they are now giving you the first 6 months of 2021 to still either A, utilize it through expenses, or B, look at your lost revenue calculation. And this slide is just showing you what quarters you would compare it to see, can you then utilize your remaining dollars and not have to then refund these dollars back to the HHS. Because in the FAQs, I'm going to conclude with this, if you go through this whole calculation up through June 30th of 2021, and you determine that A, you did not spend enough in your healthcare related expenses or lost revenue, you are then required to return these funds. Now, from what we're hearing, most likely there's going to be an extension past June 30th. So we've been looking to see if that's forthcoming, as well as they don't want you to return the dollars, right? The intent was for you to keep these dollars, to put it back into the healthcare system and to assist everyone during this difficult time. So, like I said, this is extremely complex, and especially with the other programs, we're here, we have been following this closely, and please reach out to us so that we can assist you with this reporting requirement. Thank you.
Okay, last polling question. What does the S2 and S2 technology solution stand for? Sachs and Seinfeld, Sachs and Sanders, Sachs and Sephardi, or Sachs and Siegfried? Wow. So out of those 4, why don't you start voting? Because if you didn't answer the other 3 polling questions, you need to answer at least 3 out of the 4. Is it Sachs and Seinfeld, Sachs and Sanders, Sachs and Safari, or Sachs and Siegfried? Fried. I don't know what how that's said, but maybe you all can correct me later. So 1, 2, 3, or 4. I'm going to give you a few more seconds in this last polling question that we have. And by the way, we are going to reach out to you, anyone who's asked some questions on the chat box, or if you have any additional questions, you know the email address to send it to, the COVID-19 email address. So let's end this with 5, 4, 3, 2, 1. What does the S2 and S2 technology stand for? Well, if you said Sachs and Safari, you would have gotten it right. Sachs and Seinfeld was clever, though, I have to admit. So no real final thoughts, because right now we are out of time, but just wanted to let you know we will continue to have these updates. We don't have one scheduled for next week, but we are keeping our fingers on the pulse of what's going on, and we will let you know. Be looking for our e-blasts, and if you have any additional questions, go to our COVID-19@sacsllp.com email address, send them to us, and also check out our center, our COVID-19 Resource Center. We are here for you. We have a bunch of different ways that we can help. So thank you for attending the webinar for today, and just bid you a good day and a profitable today as well. Take care.